What if your safety net becomes a trap? Most people investing in the stock market lose money and often have unrealistic expectations about growing their money. Learn about the flash crash that makes your stop loss to be just a loss. The stock market can seem like a really confusing place, but at its heart, it's just a way for people to buy and sell pieces of companies called stocks or shares. Think of it like this. Imagine your friend wants to start a lemonade stand, but they need some money to buy lemons and sugar. They could ask you to invest in their business. In exchange for your money, they give you a share of their company. If the lemonade stand makes a lot of money, you get a cut of the profits. That's similar to how the stock market works, but on a much, much bigger scale. When you invest in the stock market, you are not buying the stock market, but rather shares in listed companies. Exchanges help with sale of listed shares. They help track the prices and do a bunch of things that can be pretty hard to track if done individually. So what exactly are these shares? A share simply represents a small ownership stake in a company. If a company has 1,000 shares and you own 1,000th of that company. Owning shares can give you certain rights, like voting on important company decisions and receiving a portion of the company's profits, often in the form of dividends. Now, how does the price of a stock get determined? It all comes down to something you've probably heard about: supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. This happens because, at that specific time, buyers are willing to pay more for the stock compared to sellers. Now, this price change and setting is done by computer algorithms. Where people place a market order, these computer algorithms immediately perform the transactions. The computers are constantly figuring out whether to increase or decrease a listed price based on current supply and demand. The computers also keep the prices on trading visible to you. Because of this, the difference between a seller willing to ask the lowest price versus the higher price from buyer, aka bid-ask spread, will usually be fractions of pennies. So long-term buyers usually would not concern themselves with that. It is very simple to open an online account to begin buying shares. These days, the stock market is watched over by the U.S. Securities and Exchange Commission, or SEC for short. The SEC makes sure that everything is fair and that companies are honest about their financial situation. In the olden days, stock markets were physical places where people shouted and waved papers. But now, almost everything happens online. Think of it like buying stuff on Amazon, but instead of buying books or electronics, you're buying pieces of companies. One thing to understand is why all of this is important. For one is that it distributes the control of world's largest companies to normal everyday people. By giving people a vote on important company decisions, it helps the companies stay responsible and not abuse too much power. You can think of these everyday people and the stock market acting as an entity to regulate the biggest companies on Earth. Plus, it gives anyone a chance to have a stake in the successes of these companies. Now, how do you judge a stock? There are a couple of metrics that can help. You've probably heard people throw around terms like PE ratio, dividend yield, and growth rate. These can seem like alphabet soup, but they're actually pretty useful tools for figuring out if a stock is a good value. The price-to-earnings ratio, PE ratio for short, can be the most popular tool and represents how much you are paying relative to how much the company is earning. The smaller the value, the better it is. However, you also have to compare companies in the same industries to get an actual measure of which stock could be a better deal. Next is the price-to-book, or PB ratio, compares what a company is worth based on market value versus how much it would be worth if it liquidates and sells all its assets. A smaller number is usually optimal, and it is a great number to look at stocks with lots of equipment, lands, and buildings, since we are comparing market prices to what we can physically liquidate. However, it is not as useful for tech companies or companies that don't hold many assets, because most of these companies derive value from software or ideas rather than tangible products. Another valuable tool is the price-to-earnings growth PEG ratio. And it builds on top of the PE ratio by factoring in how much profits it is projected to earn in the future based on current growth rate. A smaller PEG ratio indicates a stronger stock valuation, and it gives investors more confidence about whether the stock is overvalued or not. Finally, there is dividend yield. Many companies pay out cash earnings to shareholders, and it becomes a stream of income from the company. The dividend yield tells you how much percentage of your investment is given back per year. For example, if you invested $100 in the stock and the dividend yield is 5%, you are given back $5 per year until the company changes it. Be aware dividend yield can be used as a trap. So if you see unusually high dividend yield, make sure there are no shady accounting or other weird factors happening behind the scenes. There are a couple of things you have to know. You always have to remember, though, that these ratios are just tools. They don't give you all the answers and should be used in combination with other ways of judging whether stocks are a good value. Plus, if a stock becomes overvalued, people can sell it, leading to the stock prices decreasing. You can also invest in these stocks through another vehicle called exchange-traded funds, or ETFs for short. These ETFs allow you to diversify your portfolio and hold positions in multiple companies across multiple sectors, rather than putting all your eggs in a basket. This all brings up a very critical part of investment, which is what you should look into in the long run. For one, you can look for companies that have been consistent at earning profits. You want a strong earning stream and not a short-time good run where profits can be all over the place. You want consistencies in these long-term investments. You will have to stomach drops in the prices, so be prepared for those and make sure to not have those emotions get the better of you. Another good practice to help you out is to avoid the news cycles too much as they try to pump you to go in for new investment. Be confident on your own decisions. Be analytical, be critical, and check the books to make sure the stock you have an eye on is truly worth the purchase. Remember, do your due diligence. Also, I was unable to cover all stock valuation methods and metrics for the video, such as return on invested capital, ROIC, and price to sales ratio, to name a few. Further research must be done on your part to properly make an informed decision. I was also unable to cover any of the bad things regarding stock investments, such as scams or company failures that investors face. To keep watching amazing videos like this, make sure to like, share, and subscribe.